We have added the Don't Trade on FOMC to our portfolio calculator. This eliminates all trades on the 8 scheduled FOMC dates. If you select one right here, we have 3 sets of rules. Don't trade if CVIX is greater than CVIX threshold. There's the CVIX threshold. Don't trade if the NQ zigzag is greater than NQ zigzag threshold. This is the average, actually, of the last 10 days if it's greater than that zigzag threshold. And then this is Don't Trade on FOMC. So in order to activate this, you set this to 1, and it will eliminate all the FOMC, scheduled FOMC meetings, not surprise meetings, not FOMC minutes, but the 8 scheduled FOMC meetings per year. You can see the current drawdown goes down, the max drawdown goes up. This number goes down slightly, but in the last, this improves it in the last, since mid-2016. So going to mid-2016, this was 50K. This number it's now 44K. If you look at this number, you see it's 44,742, and you don't surpass 50K until you go back to this time frame, which is in 2011, I believe. So in the last 10 years, your worst case drawdown is 44K if you don't trade on FOMC. And if you do trade on FOMC, your worst case drawdown in the last 10 years is this 50K number. See, this drawdown is worse right here, and your current drawdown is worse. And you also have that scenario where we were at this point, we ran at equity peaks, and it came right here. And so we're a little better in recent years not trading on FOMC. 8 scheduled meetings, and the way to implement that is by 4 p.m. Central Standard Time, 5 p.m. Eastern Standard Time. You would make sure all swing trades were exited. You would not trade until the market reopened on 5 p.m. on FOMC day. So if it's 5 p.m. on FOMC day, you re-enter your any swing strategies, even if they were more profitable than when you exited them. That's how you would implement this setup, because you're multiplying the daily P&L for FOMC days by 0, and the day starts at 5 p.m. Central Standard Time, and so and it ends at 4 p.m. So at 4 p.m. the day before FOMC, you exit. 5 p.m. on the day of FOMC will actually be the new session for the following day. So you'd re-enter any swing positions at the current price in order to implement this setup. So that is the Don't Trade on FOMC rule that I've added to the portfolio calculator. You can see it in the external rules right here. And here is FOMC dates. 1 is the FOMC date. So the first one right here is January the 30th, 2008. Once again, these are scheduled. These are not the surprise or unscheduled meetings, because you couldn't implement that. You can't go back and say, oh, I wouldn't have traded during this surprise meeting. You didn't know it was going to happen. You can only do that. You can only implement something like this if you could have done, if you could still do it in the future, and we can. There is a list of FOMC meetings, 8 per year, and you don't have to trade on that day. You multiply the results by 0. The FOMC rule is 0, so if any of these are 0, it ends up being a 0 day. So you can multiply these rules by 0. So if I add, for example, the CVIX rule and this rule, it will also come in and affect these columns on the CVIX. And if any of those are 0 for that day, then the sum of all rule, then this one is 0, and it multiplies that times the daily P&L and this daily P&L too. And so essentially you're eliminating that FOMC 8 going back for 8 days, going back to 2008. So 13 previous years from 2008 to 2021. And so we've eliminated a lot of days. I guess that would be about 100 trading days were eliminated when you do that. Eliminate 8 days per year for 13 years. So that's the new FOMC rule you could implement in this setup. And once again, the longer term drawdown is higher, but the shorter term drawdown is lower. And we're mainly focused on mid-2016 forward versus all this back here. We're not really focused on this time frame back here. The relevancy of the market is different, and so we're focused on this time frame, mid-2016 forward. Even if you go back the last 10 years, it starts right about here. So It improves it from 50K to 44K on the worst case drawdown. And so the risk to worst case drawdown in that case, if you don't trade on FOMC, is about 10K per E-mini and 1K per micro. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.